Hello, my name's Todd Mercer.
And I'm Lexi Had, and we're the founders and managing partners of Mercer Wealth Management. Back in January, we hosted our 2023 Market and Economic Outlook. We're going to break that seminar down into smaller pieces for you. So we're going to start today covering our 2022 predictions and our scorecard. The next video will be where we're at today and the current market and economic landscape that we're in. And then our last video will be our 2023 predictions.
So let's jump into the numbers. We have 3 quick slides to show you what 2022 looked like. First rule of thumb, I guess, in our business is don't fight the Fed. And that definitely came to fruition last year with the Fed raising rates and tightening the money supply. The first slide we have here has all the major market indexes, and where you can see their S&P is down 18.63%. What's interesting is the equally weighted S&P was only down 11.62, which shows you how indexing works in bull markets, but does not work so well in bear markets. All the other major indices, both domestic and globally, finished down in double digits. And of course, bond prices rose significantly. Our bond interest rates rose significantly. From the 10-year went from 150 to 388 and was as high as 4.2 last year. Oil prices finished up, gold prices finished up, the dollar finished stronger, and so did housing prices. The next slide that we have just shows how commodity prices did. And again, the first half of the year, commodity prices really spiked. That was both prices on commodities and the dollar trade. And you can see how the orange line here is the aggregate bond index, which is a yardstick of the bond market. Of course, finished down double digits. And again, the S&P 500 finished down almost in bear market territory at 18.63%. The next slide just talks about the 11 major sectors of the S&P 500. There were 2 sectors positive last year. Energy was up 64.5%, and utilities were up about 1.5%. What's interesting about this is the sectors that have led the market over the last 4 or 5 years finished down well into the double digits. Real estate, information technology, consumer discretionary, and communication services all finished down 25% or better last year.
So we made 14 predictions last year, so let's see how we did. Our first prediction was that we would have a possible recession at the end of the year or in 2023. There was a lot of debate about this, but there were 2 consecutive quarters of negative GDP, so we're going to call that one that we got it right.
Our second prediction was the U.S. markets would struggle and have a possible negative return. Well, we definitely got that one right. As we said, the S&P was down at 18.63%, and the rest of the markets were down that much or worse.
Our next prediction was that global markets would struggle and emerging markets could be worse. We got this one right. So global markets did struggle, particularly with the situation in Ukraine. Developed international markets were down north of 15 and emerging markets about 20.
Number 4, energy prices would increase. We got that one right. And even though energy prices were only up a little over 5%, or a barrel of oil was only up 5%, for most of the year, it averaged about $94 a barrel, so much, much higher for the year.
Next, we said that commodity prices would increase. We've already told you that we saw some of the highest commodity prices in the last 50 years. We did see those start to ease towards the end of the year, but commodities did still finish higher.
Number 6, interest rates long and short would rise. We definitely got that one right. The Fed increased interest rates 7 times last year and ended their 14-year quantitative easing phase. And the 10-year, of course, more than doubled from 1.5 to 3.88%.
Number 7, we said inflation would still remain an issue. And that was correct. Mid-year inflation hit 9.1%. And even though the Fed's actions did start to take effect, we still ended the year with inflation running about 6.5%. And we see consumers starting to feel the pinch.
Number 8, we're going to say we missed that. The dollar may weaken. The dollar, as we said earlier, actually strengthened during the first half of the year. It did back off towards the second part of the year, but the dollar definitely strengthened last year.
Number 9, we said unemployment would remain steady, but we would start to have issues with the labor market. We saw that to be true. Towards the end of the year, we saw massive layoffs, particularly in the tech sector.
Number 10, we got that one right. Business and consumer confidence would start to fall. Due to inflation and rising interest rates and the slowing economy, consumer and business confidence has been some of the lowest it's been in the last 15 years. Corporate earnings would be good through the end of the third quarter. We definitely saw that. The first half of the year, corporate earnings were really good, and then inflation and rising interest rates again started to affect corporate earnings, and we definitely have seen that in the fourth quarter of 2022.
Our next prediction that we made was that we would have gridlock in DC with it being an election year. We're going to say that we got this one wrong. There were several pieces of legislation passed: the bipartisan gun legislation, the transportation bill, and you also had the Inflation Reduction Act go through reconciliation. And then our next prediction was that COVID would still be an issue. And we did see new variants pop up throughout the year, but the biggest issue was the impact from China remaining closed and how that impacted supply chains, and then also the lasting impact on the labor markets.
Number 14, we would have volatility again. And we definitely had volatility last year. We had multiple corrections into bear market territory, the S&P 500s, and almost double-digit number of corrections in the 10% or more.
So out of our 14 predictions, we got 12 right. That's an 86%. I'd say that's pretty good. Let's take a moment to take a look at our 2022 positioning and how we positioned client portfolios at the beginning of last year.
So knowing that the Fed was going to take the punch bowl away and raise rates and tighten the money supply, we made some pretty substantial changes to our portfolios. We recommended clients take everything out of growth or anything out of a risk asset and move to this portfolio: 20 to 40% in long quality equities, 20 to 40% in alternative investments, and 20 to 40% in cash or short-term hybrid fixed income investments. And that portfolio held up pretty well last year in the rising rates environment we were in and in the inflationary environment that we were in.
So stay tuned for our next video. We'll be covering the current market environment today. And then again, our third video will be our 2023 predictions. If you liked this video or found it helpful, please subscribe to our YouTube channel, like the video, and share it with your family and friends. Thanks, and have a great day.